Hey everyone, it's Imran. I'm back again with another one of your macro options dailies. All right, debt ceiling angst seems to be keeping broader markets in a bit of a holding pattern. Really can't shake this level on the S&P right now. We do also have OPEX on Friday, which may be playing its part as well. So 41.50 seems to have a bit of gravity right now. We're really struggling to shake that off. China did manage to bounce 4.5% in the FXI. That was a good rally. We had Michael Burry of the Big Short out buying e-commerce names. So that was taken well. But we did also see weak economic data, though, out of China, which wasn't so positive. But maybe the market sees that as a sign that they're going to have to drop some more stimulus. Okay, anyway, outside of equities, we had commodities steadying a bit. Precious metals, small bouncing, as was copper. Energy really leading the way. Oil up 1.5%, but nat gas up 4.5%. So nat gas really starting to string a few days of momentum together now. We've got UNG back up to 7 here, 6% on the week. And then we've got vols finally reacting in nat gas, up 5 vols with that rally, as we have been banging the drum about for a while now, saying that we think that you're going to get vols higher in nat gas only if spot goes higher, right? And we are certainly starting to see that sort of price action come through. So hopefully that works well for those of you who listened to me and bought some calls in nat gas. Okay, outside of that, looking at vols, we've got a bit of a bounce here in vols in US. Now, that may well just be due to the fact that the 1 month volatility, which we measure, now captures the FOMC in June. And because that FOMC meeting has got some uncertainty around it, then that's going to add a little bit to the volatility, right? So that it may well be that more than anything else. Europe and Asia vols were also slightly firmer by about half a vol. And China seeing vol going up with the market, right? Again, something we've been saying for those of you who subscribe to our weekly overlay product. We analyze the skew in a lot more detail and depth there. And we've started to notice that FXI, the relationship between spot and vol in FXI, to us was suggesting that we may see a spot up, vol up type dynamic coming back in China. And there's your first kind of sniff of that type of thing happening. Okay. Commodity vols were mixed. We had precious metals firming up a little bit. We had nat gas up a lot, like I said, and oil drifting slightly. Skew did rebound in the US. Again, it's been chopping around, but generally quite elevated in the 65th percentile for S&P. We do think that's going to remain steep until the debt ceiling is resolved, which may then provide some Vanna fuel once you get an agreement. And if that skew does soften dramatically, then that may provide some buying from the dealers who are hedging the impact of that skew move. Okay, China's skew also flattening again, dropping by about a vol. So that is the lowest skew we've got across the major indices, which makes sense. People are starting to now cotton onto the idea that vols have come down quite a long way in China. And if we were to start to get a rally, then they would likely go higher, not lower. And then the only interesting thing to call out in skew in the commodities is that we saw a drop in GDX skew that takes it to a call premium now, takes it negative. And that's in line with what we've already seen in gold and silver for quite some time. So finally, again, in our skew analysis, we showed that GDX shouldn't have a skew for puts. We couldn't really understand why it did, but it shouldn't have based on how vol and spot are behaving. Finally, the market's kind of caught onto that and taken it into a call premium. Now, sometimes people will still put a put premium on it just because it is shares, and equities in general always have a premium for puts. But the way GDX is so correlated to the actual gold price means that it did make more sense for it to have a call premium. And now the market has repriced to that. Okay, looking at charts, what am I seeing? Investor pessimism ahead of the debt ceiling. So if we look at the chart on the left, here we've got the S&P performance this year compared to what it did in 2011. Last time we had a big debt ceiling issue, and you can see it's eerily similar. So really tracking that price action quite well here. The blue line being this year. So you should anticipate some sort of sell-off if it's going to continue with that. Now D-Day was a bit later that year. Looks like D-Day is going to come in early June, right? So this wobble here may well be around D-Day. Now, the big drop that we had of about 15% in 2011 was actually on the back of the downgrade. The US debt was downgraded. So after they actually agreed the debt ceiling and they raised it. They raised it, and then the idea was they downgraded them because they were raising too much debt. So we'll see what happens. But D-Day is approaching sometime in June, it looks like. We've got another meeting scheduled today. I doubt anything comes from it due to political wrangling, and they're gonna take it to the wire. Investors are clearly cautious on risk assets, even though no one really believes the US is going to default. It's only really the CDS market in US rates is kind of suggesting there's a problem. Everyone else kind of ignoring it, except for the real aggressive sell-off, as we said, happened after the debt ceiling was agreed. And the recent fund manager survey shows pessimism has increased in May. It's not as bad as it was last October, but we've seen elevated skew. We've seen elevated VVIX. So it is suggesting that investors are reaching for protection for the downside tail that they are concerned may materialize ahead of this debt ceiling. Now, we do wonder if anyone has thought to hedge the right tail, because as and when this does get agreed, we may see animal spirits come back a little bit. And we know tech seems to be the only game in town right now, but the leadership in tech has been confined to a narrow group of mega cap names. But if that strength in tech was to broaden out a bit, then there might still be some opportunity in tech, which is what we're going to talk about in our trade idea a bit later on. Okay, moving on to that trade idea. So is ARK setting up for the next wave higher, right? So ARK obviously had a stellar rally in January, went from like 30 to 45. So it's a 50% up move in Jan, which was pretty incredible. And it was being rewarded for like cost cutting and things like that from a lot of these tech names. Okay, but they'd had a really bad time the year before. They were pretty beaten up, and they were looking, a lot cheaper than they were. Now we've had a consolidation phase, pretty textbook in terms of how it looks, ABC type structure. And then the question now is this last leg the start of something real? Okay, because if it is, and we do get a next impulse higher, there's no reason why, as a measured move, that can't go as far as 52.5. So that might be the target zone for the next leg higher in ARK if it happens. And I kind of think this 40.5 area would be your kind of green light. Once it breaks above that, then there's kind of not a lot stopping it to have a go. Okay, so that's the idea, that we may have quite a lot of upside if we were to break 40. We may basically have another 20-25% of upside in ARK as these names re-rate. Okay, so that's really the question. Now we have had, obviously Tesla's been weak, so the ARK basket has been struggling to really keep up with the NASDAQ, but Tesla's been weak due to increased competition. They've been lowering their car prices, but the likes of David Tepper of Appaloosa has recently been buying apparently things like Tesla, things like the ARK basket. And he's generally quite shrewd and quite good in terms of his views. So maybe he's a bit more long term. So maybe it's not a good tactical signal, but the fact that he's buying this is interesting to me. After consolidating that move down to from January, it has pulled back to these Fibonacci retracement type levels, and it has bounced off there. So technically, it is looking like there's a setup here for it to go higher. Okay, but obviously we need the broader market to be okay and the debt ceiling to be resolved. But this is where there might still be some value. It's hard to really call value in NASDAQ with these mega caps going nuts and this AI revolution and all these big cap names like Microsoft and Nvidia just going through the roof. Whereas these names have kind of been left behind a bit and they are still innovating. There's obviously some crypto exposure in here as well. And if you do think crypto's got another leg higher as well, then that's a way to participate. Now, looking at the upside volatility in ARK, you can see the green surface is the current surface. So the vol's currently around here, but the upside is pretty cheap. And that upside vol, we have not seen implied vol. If you look at all the dots, we have not seen implied vol at those levels in a very, very long time. Okay, so certainly is starting to look interesting from a value perspective. If this thing can break to the upside, we know how ARK can move, and these vols in the mid-30s don't look very expensive to kind of get exposure to that. All right, so that's the idea. Looking at the dashboard, obviously the mean reversion strategy compass is going to be saying buy puts because we're closer to the top end of the range but the range has been narrowing in ARK, and vols are on the lows basically. So with vol at the lows and spot at the top end, it's going to say buy puts. I, however, would rather get some exposure to a potential upside breakout here. I've got enough other bearish things in the book, or the book is quite de-risked. So actually for me, It's more about how can I participate in some upside if the market does the unexpected, right? So that's really what I'm thinking about. Carry wise, fairly neutral here. Term structure is a bit steep, but you need a bit of time for these sort of things to materialize if we are going to get a rally. So I wouldn't go too short dated personally, but because vol is cheap, what you don't mind doing is a long Vega structure. Okay, so the long Vega structure that I'm looking at is, and that's it for today, and I'll catch you guys tomorrow. Cheers.